What if I told you Bitcoin has crashed over 80%? More than once, and yet it's still here? Banks collapsed. Exchanges vanished overnight. Headlines screamed, Bitcoin is dead. And every single time, it came back stronger. Today, we're not here to hype. We're here to understand why Bitcoin keeps crashing and why people keep coming back. Imagine this. You open your phone. Bitcoin is down 20% in one day. Twitter is panicking. YouTube thumbnails are screaming crypto is over. Your brain switches to survival mode. This reaction isn't new. It's the same fear humans felt during the 2008 financial crisis, the dot-com bubble, and even the Great Depression. Bitcoin crashes aren't just about charts. They're about human psychology, fear, greed, overconfidence, and regret. To understand Bitcoin's future, we have to revisit its darkest moments. Bitcoin's first major crash happened in 2011. Price dropped from around $32 to $2. That's a 94% collapse. Why? Early exchanges were fragile. Hacks were common. MTGOX, the largest exchange at the time, was breached. Back then, Bitcoin wasn't an asset. It was an experiment. Most people thought, okay, that was fun. It's over. Lesson: early innovations always break before they mature. In 2013, Bitcoin surged past $1,100 for the first time. Mainstream media noticed. So did regulators. Then came the crash, over 85% down. Why? China restricted Bitcoin usage. MTGOX collapsed in 2014, losing 850,000 BTC. Trust evaporated overnight. For many Americans, this was their first Bitcoin heartbreak. Lesson: when infrastructure fails, confidence collapses faster than price. 2017 was pure madness. Bitcoin hit nearly $20,000. Everyone was a crypto expert. ICOs promised overnight wealth. Then, reality hit. By 2018, Bitcoin crashed 84%, down to around $3,200. What went wrong? Massive retail speculation, weak projects with no fundamentals, regulatory pressure from the SEC. This felt like the dot-com crash of crypto. Just like Amazon survived while Pets.com didn't, Bitcoin survived. Lesson: hype attracts crowds. Crashes remove illusions. March 2020. Global markets collapse. Stocks crash. Oil crashes. Bitcoin? Down 50% in a single day. People said, Bitcoin was supposed to protect us. But here's the twist. After the panic, Bitcoin exploded upward. Why? Federal Reserve printed trillions. Interest rates dropped to zero. Institutions like MicroStrategy and Tesla entered. Lesson: liquidity shocks cause crashes. Monetary fear fuels rebounds. This was the most emotional crash. Bitcoin fell from $69,000 to under $16,000. Reasons: Terra/Luna collapse, FTX exchange implosion, high-profile arrests, rising interest rates by the Fed. This wasn't just price damage, it was trust damage. For many Americans, this felt worse than 2018. Lesson: centralized failures hurt decentralized ideas. Bitcoin crashes follow a repeating psychological cycle: innovation curiosity, price rise excitement, FOMO mass entry, overconfidence leverage, shock panic, capitulation despair. This isn't unique to crypto. It happened with railroads, internet stocks, and housing. As Warren Buffett once said, be fearful when others are greedy. Lesson: markets punish emotion, not intelligence. Here's what history quietly teaches. Bitcoin has never crashed because of code failure. Every crash involved human behavior or centralized risk. Long-term belief is tested only during pain. Volatility is the price of innovation. Bitcoin doesn't reward impatience. It reveals who understands risk. And who doesn't? Bitcoin crashes aren't glitches. They're stress tests. Each crash removes weak hands, bad actors, and false narratives. What remains is stronger, slower, and more resilient. History doesn't repeat, but it rhymes. If you want more breakdowns on crypto psychology, market history, and real lessons behind the headlines, follow and subscribe for smarter crypto stories. Did you know that over 90% of retail traders lose money in the stock market every year? Not because they lack knowledge, not because they picked the wrong stock, but because they let emotions control their decisions. Fear, greed, and overconfidence quietly destroy portfolios. Today, we're diving deep into how emotional trading ruins US investors and how to fight it. Picture this: the stock is soaring. Everyone on Reddit and Twitter is cheering. You don't want to miss out. You buy at the peak. A few days later, the stock crashes. Panic sets in. You sell. At a huge loss. It's not just you. Millions of Americans repeat this pattern every year. Even experienced investors, think Carl Icahn or Ray Dalio, warn about this. Emotional trading makes you react to the market rather than plan for it. And the most dangerous part? You often don't even realize it's happening. Let's go back to March 2020. The COVID-19 pandemic hits. Stock markets crash over 30% in days. Retail investors panic. Fear overwhelms logic. Many sell everything at the bottom. Meanwhile, disciplined investors like Warren Buffett or firms like Berkshire Hathaway hold steady. They buy when others panic, and profits follow in the rebound. Lesson: fear-driven trading locks in losses. Patience unlocks gains. Fast forward to 2021, the meme stock craze. GameStop, AMC, Dogecoin. Everyone wants a piece of the hype. Investors see friends doubling money. They buy at sky-high prices. The peak hits, and then the crash comes. Greed pushed people into positions without research. FOMO caused emotional leverage. Lesson: chasing trends often leads to buying at the top and selling at the bottom. Emotion is the silent killer. Why do we act this way? It's science, loss aversion. Losing $1 hurts more than gaining $1 feels good. Overconfidence. I've got this makes you ignore red flags. Herd mentality. People follow the crowd, even into disaster. Example: the 2008 financial crisis. Many Americans invested in housing and financial products they didn't understand. Fear and panic caused massive selling, creating a downward spiral. Markets don't punish mistakes as much as they punish emotional reactions. Lesson: controlling your mind is more important than controlling the market. Crypto amplifies emotional trading. Bitcoin and Ethereum can swing 10 to 20% in a single day. In 2017, many bought Bitcoin at $19,000 driven by hype. By 2018, it crashed to $3,200. Some US investors sold in panic. Others held and prospered. Lesson: volatility exposes emotions. Discipline protects capital. Here's how top investors survive emotional markets. Have a plan. Set entry, exit, and stop-loss levels beforehand. Stick to rules, not feelings. Trade based on logic, not headlines. Diversify. Don't put all eggs in emotional baskets. Take breaks. Step back when markets are stressful. Learn from history. Study crashes and corrections to expect volatility. Even legends like Peter Lynch stress: investing is not a game where the guy with a 160 IQ beats the guy with 130 IQ. It's the discipline to stay calm when others panic. Let's quantify it. Emotional trading can cost investors 10 to 30% annually compared to disciplined strategies. Frequent buying and selling increases fees and taxes, compounding losses. Emotional investors often miss market rebounds, locking in temporary losses permanently. Psychologically, humans are wired to react to threats immediately, but financial markets reward strategic patience. Lesson: mastering your mind is more profitable than mastering the market. Emotional trading doesn't just hurt portfolios, it destroys confidence, sleep, and your financial future. The good news? Awareness is the first step. Recognize fear, greed, and FOMO. Build rules. Stick to them. Patience pays. If you want more insights on market psychology, investing mistakes, and lessons from top US investors, follow and subscribe for smarter finance lessons.
What if your cryptocurrency could one day help you get a bank loan, not from a startup, not from a tech company, but from one of the largest banks in the world? Imagine walking into a traditional bank, the kind that once rejected crypto completely, and hearing this question: would you like to use your digital assets as collateral? That future may be closer than we think, because Russia's largest bank, Sberbank, is reportedly exploring crypto-backed lending. A move that could quietly signal a massive shift in how the global financial system views cryptocurrency. This is not hype. This is not speculation. This is a moment worth paying attention to. So pause for a second, because what you're about to hear could change how money itself works. Why this matters: for years, cryptocurrency has lived in two worlds. In one world, it was seen as risky, unstable, and untrustworthy. In the other, it was hailed as the future of finance. Banks stood firmly on one side. Crypto communities stood on the other. Now, those lines are starting to blur. When a major state-linked bank like Sberbank considers crypto-backed lending, it sends a message, not just to Russia, but to the world. In this video, you'll learn what crypto-backed lending actually is, why Sberbank's move matters globally, how traditional banks are slowly changing their mindset, what this means for everyday people, investors, and the future of finance. No hype, no technical jargon overload, just clear explanations and calm analysis. Let's begin. What is crypto-backed lending? To understand why this is important, we need to start simple. Traditionally, when you take a loan from a bank, you need collateral. That could be a house, a car, gold, or other valuable assets. Collateral gives the bank security. Now replace those traditional assets with cryptocurrency. Crypto-backed lending means you deposit your crypto, like Bitcoin or other digital assets, as collateral, and the bank lends you traditional money against it. You don't sell your crypto. You don't lose ownership. You simply lock it temporarily. This idea already exists in the crypto world through platforms and startups. But here's the key difference. This time, it's a traditional bank considering it. Pause and think about that for a moment. Banks are built on caution. They move slowly. They resist change. So why would they even consider this? Why banks once rejected crypto? For most of crypto's history, banks saw it as a threat. Why? First, volatility. Crypto prices can rise and fall sharply. Banks don't like uncertainty. Second, regulation concerns. Many governments struggled to define clear rules around crypto. Third, loss of control. Crypto operates without central authority. Banks are central authorities. From a psychological perspective, this is normal. Institutions protect systems that made them successful. Think about how taxi companies reacted to ride-sharing apps, video rental stores reacted to streaming, newspapers reacted to the internet. At first, they resist. Then they observe. Then, slowly, they adapt. Sberbank's move suggests we are entering the adaptation phase. Why Sberbank's move is globally important? Sberbank is not a small player. It is one of the largest banks in Europe, a dominant financial institution in Russia, a bank with strong influence over economic direction. When a bank of this size explores crypto-backed lending, it does three things. Key cap 1, it legitimizes crypto further. Crypto stops looking like an outsider asset and starts looking like financial infrastructure. It pressures other banks. Banks watch each other closely. If one major institution experiments, others begin to study it. Key cap 3, it changes public perception. When people see crypto connected to familiar institutions, fear decreases. This is how mainstream adoption actually happens, not loudly, but quietly. Not through headlines alone, but through internal policy discussions and pilot programs. How this could change the financial system? Let's zoom out. Crypto-backed lending connects two worlds, traditional finance, digital finance. This creates a hybrid system. In such a system, digital assets gain real-world utility, banks gain access to new forms of collateral, liquidity increases without forced selling. This could reduce one major crypto problem: people selling assets just to access cash. From a practical angle, this helps long-term holders, businesses holding crypto, individuals in countries with limited financial access, and psychologically, it shifts crypto from speculation to function. That shift matters more than price. Risks, challenges, and reality check. Now let's slow down and stay grounded. This is not a perfect system. There are real challenges: price volatility management, legal clarity, asset custody and security, risk assessment models. Banks will likely start cautiously, limit asset types, use conservative loan-to-value ratios. This is not mass adoption overnight. It's testing, it's learning, it's controlled experimentation, and that's actually a good sign, because systems that last are built slowly. Practical takeaways for viewers. So what can you take from this? Here are a few grounded lessons. Keycap 1: Watch institutions, not just prices. Adoption shows up in policies before charts. Keycap 2: Utility matters more than hype. Assets gain strength when they solve real problems. Keycap 3: Financial systems evolve gradually. Big changes rarely happen in one dramatic moment. Keycap 4: Education is a long-term advantage. Understanding systems early gives clarity later. Pause and reflect. Are you watching the noise? Or the direction? A quiet financial shift. Sberbank exploring crypto-backed lending does not mean the financial world has fully changed. But it does mean something important. The conversation has changed. Crypto is no longer just being discussed at the edges. It's being evaluated inside boardrooms. And history shows us, when institutions start asking questions, transformation follows. Not loudly, not instantly, but steadily. The future of finance may not belong to one system or the other, but to those who learn how both can coexist. If this video helped you understand the bigger picture, consider liking it. It really helps the channel. If you enjoy calm, thoughtful breakdowns of global trends, subscribe for more content like this. And share your thoughts below. Do you think traditional banks and crypto will fully merge one day? Thanks for watching. Stay curious. And I'll see you in the next video.